If you're like most traders, you'll get stopped out of a lot of trades because you take a long position on a stock which sells off, or you shorted a stock that rallies. And obviously this can be a frustrating process. I'm the head trader of SMB Capital's options trading desk here in Manhattan, and the traders on our options desk utilize a trading style that instead of having to get the direction right on a stock or an ETF, we can actually react to how the market's behaving and create a range of prices, both up and down, over which we can win on a trade. So if you're interested in a one-day trade that allows you to react to the market and win over a wide range of closing prices, then stick around because I think you're going to find this interesting. Hi, I'm Seth Freuberg, and I'm the head trader of SMB Capital's options trading desk. SMB Capital is a proprietary trading firm located in Midtown Manhattan, and we provide capital for options and equity traders from all over the world, trading both remotely and in our offices here in New York City. Now, I'd like to suggest you click on our subscribe button right now so that you don't miss any of our free trading videos that we produce for traders and investors all over the world. They're really very valuable. Okay, so in a recent video, we taught everybody a one-day option strategy that you can make by trading S&P 500 options in a certain way by establishing daily support and resistance levels and winning in any range between those two levels. Today, we're going to be teaching you a trade that involves you simply reacting to how the market's behaving on any given day to show you how flexible options income trading can actually be. So let's go back to June 10th. A few weeks back, and you'll see that the S&P 500 index was trading at about 32.15, having rallied substantially from the crash earlier in the year. Now, what we'll be demonstrating today is a one-day options trade where you use the options that are traded on the SPX index, the index of the S&P 500 stocks. Now, before we do that, we've got to make sure that everyone out there understands how index options work specifically, and then we can move into the strategy that I'd like to teach you today. Okay, so now almost all of you are probably familiar with equity options, where a call buys you the right to buy 100 shares of a stock at the strike price of that option anytime before the option expires, and a put option entitles you to sell 100 shares at the strike price of the put before that option expires. But there are also index options, which work similarly to equity options, except there's no such thing as 100 shares of an index like the S&P 500. You can't really buy or sell 100 shares of an index, but what you can do is get paid in cash, $100 per point if the index expires above the strike price of an index call that you buy, or alternatively, you'd be paid $100 per point for each point the index drops below the strike price of your index put. So, for example, if an index is trading at 1400 and you buy the 1410 call, if the index goes to 1415, you'd receive $500 into your account. If the index closes at 1410 or lower, your call expires worthless. On the other side of the ledger, if you buy a 1385 put and the market sells off to 1375, you'd make $1,000. But if the market just sold off to 1385 or higher, the put would expire worthless. So those are the basics of index options. And remember, you can buy options, but your broker will allow you to sell options as well. And your broker will allow you to put together combinations of options. In other words, option strategies that involve both short and long options purchased in a way that's advantageous to you as a trader. Now, let's go back to the open on June 10th. And what I'd like you to focus on is the options chain that expires on that same day, June 10th. So what we could have done that day at the open was to open up an options trade known as an iron butterfly. And in this case, the way we're going to construct this iron butterfly is by selling 5 calls and 5 puts at the same strike, that 32.15 strike, which is where the market's trading, what options traders call the at-the-money strike. And then we're going to flank the 5 short calls by buying 5 long calls, 50 points above the short calls up at 32.65, and flank the short puts with 5 puts down at 31.65, which is 50 points under the short puts. So this iron butterfly with shorts at the money and longs equidistant from the money could have been entered this morning for the prices that you can see in that market price column. So let's first break down what's going on here from a cash flow standpoint so you understand how the trade sets up. So we bought the 32.65 call for $1.73, and remember, each point beyond the strike price of the option is worth $100. So we multiply that cost by $100, and we've bought 5 of everything. So that represented a total cost for us of $865, as you can see from the calculation. Then we sold those 32.15 calls for $15.76 times 100 again, and we sold 5, as we explained, so that represents cash received in our account of $78.80. Similarly, we sold those 5 puts also at 32.15, and as you can see from the calculation, that brought in $74.45, and finally we bought the 5 31.65 puts for a total cash outlay of $13.75, which when you net it all out creates a cash inflow into our account of $13,085. Now, for reasons we'll get into in another video, the total risk on this trade is $11,915, and that's how much your broker would have required you to set aside in your account to make this trade, and how much is technically at risk on this trade if it wasn't managed, but we're going to manage it very carefully, as you're about to see. Now, before we get into exactly how we're going to manage this trade to respond to what the market's actually doing price-wise, I wanted to let you know that there are many more sound, viable, long-term techniques for trading options for income. And in fact, we're currently running a 2-hour free intensive workshop at the moment where we'll be teaching you 3 of those strategies that real professional options traders use, including a really simple but incredibly effective strategy that some of the greatest investors in the world use all the time, plus an options trading strategy that has a statistical 80% probability of profit month in and month out, plus an option strategy that you can employ with a stock that you like, where you'll make your target profit whether the stock goes up, goes nowhere, or even goes down a small percentage. So if you're interested in those strategies, then you should check out the free options class that we're currently running. Just go ahead and click the link that should be appearing now at the top right corner of your screen. That will open the free registration page in a new window, so don't worry, you won't lose this video. Or you just head on over to optionsclass.com to register for this free intensive workshop. It's a rare opportunity for retail traders and investors to learn directly from Wall Street traders, but that's exactly what you'll be getting through this free online workshop. So click the link to sign up now and don't miss it. Okay, so now back to our one-day SPX trade. Now that we've entered into, it's important to point out that for reasons I'll get into in another video, on this trade, this position, if left alone and not managed, by the close of the trading day, we'll make a profit at anywhere between $31.90 and $32.40. We'll get into why that is the case in another video, but for now, let's work with that assumption. So our plan is that if during the day the market moves outside of that range, we're going to manage the position and expand that range, as you'll see in a minute. And this is what options traders call adjustments to your starting position, which is really how professional options traders prosper. So let's move now to 10:30, and you'll see that the market very quickly sold off this day, and by 10:30, the SPX had dropped to 31.90, which is at the bottom edge of the profit zone that I just mentioned. And so what we're going to do is basically move both put options down 35 points to 31.80 for the 5 short put options and 31.30 for the 5 long put options. So the way that we actually execute that is called a Condor roll, which, as you can see from the picture, involves us buying back the short puts at 32.15 and then selling 5 puts at 31.80, while at the same time selling the original long puts that we bought in the beginning down at 31.65 and buying the 5 new puts at 31.30. So when we do all 4 of those at once, which can be done easily, by the way, through your online broker in an order ticket, it's called a Condor roll. And when the transaction's completed, the position looks like this, with the short calls now at the original position and the short puts 35 points below that at 31.80. Now, from a cash flow perspective, remember, we originally received cash of about $13,000 for initially entering into this position. But what you need to realize is that we just spent a bunch of that to do that Condor roll. Here's the cash flow on that Condor roll to make this clear to you. Keep in mind that we originally received $13,085 for the Condor at the beginning of the day. To buy back the 5 puts at 32.15, we needed to pay $30.45 as they had gotten much more expensive as the market sold off. And so that cost us $15,225 to buy those 5 back. But then we received cash for selling the short puts at 13.80 and also selling off the original long puts at 31.65. And finally, we paid out cash for buying the new long put position at 31.30. So when you do all the math, the Condor roll cost us a lot of the original cash flow, but nonetheless, we are left over with $5,800 from that original cash credit. Okay, now we're going to move to 2:15 in the afternoon. And as you can see now, the market has moved strongly upwards, now up again for the day at 32.22. Now, in this particular trading style, once the short put and short call are no longer at the same strike, as soon as the market passed the short call to the upside, we then do essentially the opposite transaction on the call side of the trade, and we execute a call side Condor. But this time, we're rolling the calls up 20 points using that same method, closing the original short call and long call and creating a new position for both 20 points higher. Here's what the position looks like once the roll is completed, with the short call now 55 points higher than the short put. The significance of this distance will become clear for you in a minute, but in the meantime, let's take another look at our cash flow after the call Condor is executed. As you can see, by the time we paid for buying back the 32.15 call and all the other transactions you see there on the exhibit, we ended up spending a lot more of that original credit. And now, after both rolls, we're still positive cash flow, but to the extent of $1,580. Okay, so now let's move to the end of the day. And as you can see, the SPX finally sold off during the end of the day, and it ended up back down at 31.90, which you'll remember it had hit earlier in the day and actually triggered our buying of the original put Condor roll. Now remember, to analyze how this trade wound up, you need to first take a look at the fact that these options expire today. And so they need to be valued at settlement at 4 p.m. So let's take each option and figure out its end of the day value. Well, the 32.85 calls, which only pay off if the market is above that price when they expire, well, those 5 calls are obviously worthless, as the SPX expired 95 points below that price. The short call also is worthless because it itself is 45 points above the closing price. The short puts only pay off if the market's below their strike prices. Well, that's not so in either case, as both strike prices are well below the final closing price of the index. And so all 4 options expire worthless. And therefore, the good news is that you get to keep the cash flow that was left over after both the put and the Condor rolls, and that's that 1580. And so since all 4 options go to options heaven and no longer exist, no one owes anybody any money, and you simply pocket your net cash flow. So if you really carefully think about what we've done here, through adjustments, we've basically created a 55-point zone between the short put and the short call. Since the long put and the long calls are even further away from the market, as long as the SPX had closed between those 2 points, we get to keep any remaining credit after we spend the money to buy the put and call Condor rolls. So the important takeaway from this video is that if we become experienced options traders, we can devise plans not to predict the market, but to know how to profit by shaping our options traders around what the market is actually doing during the day, and then creating zones where we are certain to make a profit as long as the market stays within that very wide zone. That's the way professional options traders do it, and that's what you can do also if you become proficient at options trading techniques. Now, just to remind you, as I said earlier, if you enjoyed this video and learned something valuable from it, and you'd like to learn the details of 3 real-world option strategies that professional options traders use all the time, then you should check out the free options class that we're currently running. Just go ahead and click the link that should appear in the top right corner of your screen right now. That will open the free registration page in a new window, so you won't lose this video, don't worry. Or you can just head on over to optionsclass.com to register for this free intensive workshop. It is a rare opportunity for retail traders and investors to learn directly from Wall Street traders, but that's exactly what you'll be getting through this free online workshop. Click the link to sign up now and don't miss it. And one more thing, I'd like to ask each of you to please click on the subscribe button. Don't forget to do that because we're producing these videos constantly to teach you how to trade options. We're posting them constantly on our channel to help you improve your game as an options trader, and that's a wonderful opportunity for you.